This week on By the Numbers, we'll dive into headlines surrounding GDP, consumer sentiment, the election year and what that means for the economy, and are people really leaving in flocks from Austin, Texas, and where are they going, and what could that signal for the overall economy? So sit back, grab a cup of coffee, and let's dive into these numbers together. Hi, Lauren.
Hi, Lyndsay.
How are you?
I'm doing great. I'm so thrilled to be here.
We are so excited for our first episode.
Yes, we're live.
We're live. Kind of.
Kind of.
They don't allow me on live TV.
No, very, very bad. So we're recorded with at least a 15-second delay,
Yep.
but we are so excited about this show, about this new way to bring information out there and cut through some of the noise.
Yeah, I think for me, at least, I was so excited for this opportunity when I heard that ITR was putting together this podcast and giving us that opportunity to do really what we do best. We have business-minded economists. We are highly accurate. We are apolitical. We are known for our stake in the ground to plan for. Why not bring that to the scary news headlines and, calm that noise and, maybe give somebody some hope. I know that's, I always laugh when I say that because I know we're not supposed to say hope, but maybe bring some reality check to a situation.
Absolutely. And I know you and I have talked about this, and we talked to other folks around the office, and there are so many headlines out there, and we read some of these often conflicting headlines, and then we go back to the data. We say, how could you read this information, get these numbers, and come up with that headline? Not that they're always outright false, right? But very misleading, or they pull just cherry pick certain numbers out to, either sell an opinion or in many cases just sell a story. And at the end of the day, we realized that's what journalists do. They work for media outlets. They're trying to sell newspapers, get eyeballs on screens. And so it makes sense. But I just don't think that's the way that business leaders should be making business decisions, or individuals should be making their own investment decisions, their own life plans. So that's something that we try to do here at ITR. We shout it from the rooftops when there's something misleading or there's a bigger, broader narrative happening in the economy. So I am so thrilled. We've been talking about this show for a while now. And since inception, it's been, how do we get this message out in a very different form than anything we've done at ITR before?
And a great point to make is that it's not just you and I. It's our production team. It's the greater ITR family that is really behind this show, and everybody's research. Everybody on your team is super excited to dig into the research and kind of debunk these fear-mongering headlines. And I know that my team is really excited to field your questions from the audience and get to know more people, more outreach through this new platform.
Absolutely. I have an amazing team of economists behind me, and we're such nerds, right? We talk in the office, we say, I found this great headline on the GDP annualized growth rate, something we'll talk about today.
Yeah.
And so we all got excited and just nerded out about statistical methods for about a half hour. So that's why, Lyndsay, I'm so glad you're here, because I feel like I will just be a total nerd and go into the data and the deep into the weeds. You always bring me back up to real life, to a more normal human level. So I'm so thrilled to be working with you to, again, not get too deep in the weeds here. We want to see the forest through the trees.
Yeah, I mean, other than just our friendship and the way that we interact with our clients, I'm so excited to work with you because, as you know, I don't watch the news on the weekends. So having this show recorded early in a week and getting the headlines from you over the weekend, you are my news anchor. Today you play Economist and I kind of play the anchor, but you are my news anchor. I get my news from you, and I think it's probably better when it comes from you or from your team, because it is that more unbiased, less emotional approach to what's happening on these headlines that are meant to draw viewership or to draw readers. So I really am excited. And I think we were talking about this in preparation for today. it's a little bit scary for me when I'm reading these articles and I'm now understanding things and my brain starts to go down these little economic trails and I'm like hearing Lauren in my head. So it just goes to show that even on this platform, I'm learning from you.
You mentioned that the other day. You picked out a deflation versus disinflation difference.
Yeah.
And I was so impressed. I'm not sure if I'm the angel or the devil on your shoulder, but I'm one or the other, probably.
Well, it was so funny. I'm listing my house and I went offline and messaged you and I said, Lauren, I know, which I would never know if I wasn't working for ITR, that the Fed meeting is coming up in the middle of June and I'm listing my house at the beginning of June. I asked you, is that a bad idea? Should I be? And you quickly reminded me that really only people in this world would know about that and allow that to perhaps influence their decision on when to list their house, give or take a few days. So the general home buyer that would be buying my house doesn't actually care.
Unlikely, but
it gave me a reason to ask a question.
Well, I love the questions. I love having this discussion. So
too.
this is going to be a lot of fun.
I know, we're so excited, and we're so excited to, like I said, bring our business-minded economist point of view to these numbers or put numbers to these headlines and really cut through the noise and help you to read what you should be taking away from these articles, less the emotion, more the facts. All right, so let's jump into the first headline of the day. This headline says GDP growth slowed to 1.6% rate in the first quarter, well below expectations. So let's start with this. Below whose expectations?
Below expectations. Isn't that always the kicker? So I'm so glad we're starting with this headline for our first story of our first show, because GDP is just a big concept, right? It's talking about the entirety of the US economy, everything we produce, the goods, the services, everything we make here in a 1-year period. And so a lot of people have a lot of thoughts and opinions on GDP. So what this article is saying is that the consensus expectations from a number of market analysts who are polled had been a little bit higher. The estimate was 2.4%, and it came in at 1.6%. Now, if you follow ITR, you might have noticed a very different narrative, because our expectations, this result actually beat. So we had been expecting a little bit slower growth. We are not surprised by this result. It was within, we give ourselves a range, right? An upper and lower boundary of the range. And this result came in between the median and high estimate from ITR. So 0.2% above our median forecast.
Talk to us about why GDP. I've heard clients before come in with a strong focus on GDP, and the economists will kind of re-steer them towards a different benchmark. So talk to me about what makes up GDP. Why do we look for GDP, or why do we look to GDP rather?
GDP is the headline. So as we're talking about the economy, if someone just asked me, well, how is the economy doing today, right? Someone I meet on an airplane. GDP is an easy headline to go to because, as I mentioned, it's very, very broad. It is everything we do here in the United States. There are good proxies, right? Good comparisons to other countries' GDP. It's not looking at, say, just the industrial sector or just the manufacturing sector. So that's something that we have to start to roll back as we're having one-on-one discussions with clients. Maybe they're a manufacturer. Well, GDP is composed about 2/3 of consumer spending, and the remainder is about evenly divided between the government and business investment.
So more heavily weighted on the consumer when talking about GDP.
Much more heavily weighted to the consumer.
Which is why it would come up on an airplane more often than a report review call.
Exactly.
Okay.
So I think a lot of folks just jump to GDP because it's what they know, gross domestic product, but it's not always the most relevant market. So that's why we like to say, know your markets, know where your sector is headed.
Back to the numbers. The article says January through March came in 1.6% annualized pace below 2.4 estimate. So this is like I was talking about before. This is one of those things where I read a paragraph and one word jumps out at me and the economist comes into my ear, angel or devil, I'm not sure which. Annualized jumped out at me here. So is that the correct focus? Should we be talking about GDP on an annualized basis? Does that tell the full story?
Here's where I'm going to get deep into the weeds.
Okay.
So annualized growth rates are how GDP is typically spoken about in the media. It's how the numbers are reported. Well, there are a number of ways the numbers are reported, but that's the one that gets the most focus. I personally believe that's not the most useful way to compare this data. Essentially, what an annualized growth rate is saying is that if GDP did whatever it did in this quarter for an entire year, an entire 4 quarters, that's what the annual growth rate would have been. But as we know, because we follow these trends so often, it's very rare for the same thing to happen 4 quarters in a row that happened in that one quarter. So we at ITR really don't like to use annualized growth rates. You might remember back in 2020 with the pandemic, right? Yeah. Everything just stopped in that second quarter. Right. The data really fell off a cliff. It was a huge annualized growth rate pullback. I think it was around 30%.
You can still see it on all of our charts, that real.
Right. Well, you see the jog, but you don't see that much of a dip because it didn't keep happening for 4 quarters.
All right.
So it happened for 1 quarter, right? It was about a quarter, one in 4.
A quarter of panic.
A quarter of panic. But that wasn't just a linear trend. And so much of what we talk about, we behave as if this trend will just keep going as it's going currently. We'll all ride off into the sunset, into equilibrium is a word we economists use. That's not how the real world works.
But it makes for good headlines.
Well, it makes for great headlines. It'll exacerbate the situation. So we at ITR, we prefer to use, I call it a 312 rate of change or a quarterly growth rate. Okay. This is looking back from 3 months of this year, that same quarter of information, to the same quarter 1 year ago. So on a 3/12 basis, it was not a 1.6% growth rate. It was actually 2.97%.
Okay.
And that compared to our forecast for 2.8%. Again, as I said before, this result beat our expectation. But 2.97%, well, that sounds a lot better than just 1.6% growth, doesn't it?
Right. So the article is saying it came in below expectations, not below ITR's expectations, though.
That's correct.
Okay. So another one of the things that jumped out at me was the use of personal consumption expenditures price index. That word was associated with a key inflation variable. When I've talked to you in the past, or I've heard you talk to our clients, we talk a lot about the consumer price index, CPI, or the producer price index, PPI. Why are we in this article focusing on the CPE?
So the PCE data, personal consumption expenditures, that's actually the Federal Reserve's preferred gauge of inflation. There are just different ways that we get information, whether from businesses, from households. And so there are different measures collected by different agencies. Typically, again, we get the CPI data a little bit sooner. And so I think it's just become more commonplace to talk about CPI or PPI if we're talking about producer prices. So the PCE data, it's another very valid, just slightly different measure of the inflation data. And here again, it rose, they call it a 3.4% annualized pace for the quarter. Core PCE, that 312 rate of change, came in at 2.87%. So we're not quite to that target 2% rate that the Federal Reserve wants yet. But here as well, if we look at, and again, core PCE strips out those more volatile food and energy applications. Okay. That's the measure the Fed is looking at. But if we look at this on a 312 basis, 2.87%, we're within shooting distance of that 2% range.
Okay, interesting that you say that, because a lot of the articles that we read, I feel when I'm reading it, the percentage points don't seem that big of a spread, but they'll say, oh, it's so far off from the Fed's 2% that they're looking for.
Exactly. Everything is relative. And so, yes, we're far off if you're talking about a Fed move. You know, this week there will be a Fed meeting, for example. I don't think we'll see any movement there. But moving in a general direction, as we talk about consumer price inflation had been peaking in the 9% range to now be down in the low single digits. It's just about framing.
Right. Okay. So let's talk about framing, because there was another section in this article that was comparing, because we, timely, it's right after the first quarter. So we're looking at full quarter figures. That's how GDP is reported into us. They're talking about consumer spending, how it increased to 2.5%. So still growth, I thought was important in the first quarter of 2024. But it was comparing it to the fourth quarter of 2023 and kind of talking about it as if that was a negative comparison. It wasn't growing quite at that same, I think it was 3.3% that came in the fourth quarter. when I look at that just as an average person, I'm thinking, okay, that is holiday spending compared to pre-tax refund season. Wouldn't everybody, as long as they were smart, be taking a little bit of a breather in the first quarter?
Lyndsay, you've been hanging out with too many economists. That's your problem. But yes, again, we take retail sales numbers, the amount of retail spending, and I don't like looking at those sequential growth rates against expectations. So here as well, if we take our 3/12 rates of change, let's do the numbers. So we take our retail sales numbers, and again, if we put this in the 3/12 basis, that quarterly growth rate, in the most recent quarter, it was a 3.5% growth rate. Compare that to the fourth quarter, it was 3.7%. So here as well, we're clearly trending in a slowing growth, but still positive growth environment. But that jump, that gap, it's not quite so exaggerated as this article made it out to be.
It feels a little bit like splitting hairs, but I'm not an economist and I'm not looking at the numbers. So those few percentage points, do they actually matter?
Well, they matter to the market. So you'll see a big reaction if the numbers beat or disappoint. But I think about those traders, the people who are just going on the reaction, trading on the sentiment. Typically, we'll see an overreaction and maybe a bounce back. But to the average consumer, no, I don't think we're really following 3.7 versus 3.5.
No.
I don't think we're really hanging our spending on this. And so that's why we at ITR, we like to pull it back. Let me just go back to that headline figure, right? That GDP growth number. Sequentially, GDP was up 0.4% quarter to quarter, if that's how you choose to look at it. That's nearly identical to our 25-year average, fourth quarter to first quarter increase. So I'm a firm believer in putting those numbers in context and saying, was this really a beat? Was this really a drop? In this case, it seems like we're trending in very normal territory.
Okay. So we've been talking about the comparisons from the 3/12 or the 3/12. We forecast GDP. We have a forecast that's out there. In fact, it's part of our trends report that's available to the general population. Permission to give it away for free a little bit here. What is ITR's outlook for GDP over the next 3 years?
So our outlook for GDP is, again, that still positive, but much slower growth. So if you didn't want any numbers, let me pull our headline away here. That is the name of the game. We are expecting GDP to trend between 1% and 2% for the next 3 years, which is, again, still positive. So the headline that I can give you is no recession forecast. We do not expect any contraction in GDP, but we do expect much slower growth than we've become accustomed to recently. So the numbers themselves, if I can do the numbers, for 2024, we expect 1.1% growth. For 2025, 1.5%, and for 2026, 1.9%.
Okay. So not so grim.
Not so grim, not runaway growth either.
No.
It's somewhere in the middle.
Happy medium.
Happy median.
What's the term you used? Equilibrium? Well, that's all the time we have for today here on our YouTube channel. Remember to like and subscribe so you can always keep up with us here on YouTube. But if you'd like to see the full-length episode, click on the link in the description to find out how. But for now, thanks for listening. Have a great day, and we'll see you next week. Bye, Lauren.
Bye, Lyndsay.